Let's keep this discussion going with Nick Maroutsos. He is the Global Bonds co-head, and he's joining us from Newport Beach, California. Are you there, Nick?
I am here. How are you?
I am good. I want to pick up on something Brian just said, which has to do with controlling the yield curve. What would that mean for average investors or for most of us in the country if the Fed were to be buying more long-term debt indefinitely?
What that does is that basically limits your upside when we're talking about bonds. You've seen other countries like Japan, Australia was the latest one to join the mix, enter into some yield curve control where they're essentially pegging interest rates at a particular level. Now, as a bond investor, this isn't something that we like to hear. Obviously, given the level of debt and the amount of debt that has increased in the balance sheet for the Fed, they need to keep rates low, not only to sort of delay the interest expense alone, but also they're encouraging people to go into riskier assets. You know, our belief, at least for today is probably going to be a bit of a snoozer when it pertains to what the Fed is going to talk about, largely because, like Brian talked about, there's not a lot of new information that they need to suggest, whether it could be forward guidance. Yield curve control is probably something that the Fed wants to save. If this crisis extends further, like another 6 months, what we're seeing is a lot of renewed optimism. Obviously, the stock market is hitting all-time highs. It's almost like there's a huge disconnect between what's happening in the market as well as the economy. And the Fed probably needs to address that. I would imagine in the Q&A that Jerome Powell is going to get asked not only how long these programs are going to last for, but what they're doing about the income inequality, what are they doing for Main Street? Because a lot of these programs that have been implemented are serving a purpose for large corporations. They've been able to gorge on significant amounts of debt, issuing long-term debt, short-term debt at significantly lower levels than they were historically. And that's not necessarily helping out the small business owner or the individuals that are being hurt the most.
Nick, it's Julie here. To your point, I'm coming back around to a discussion I think we had at the beginning when the Fed started this stimulus, which was, are low rates really the problem when you've got an economy that's shut down? And I think the answer is not necessarily, but the Fed's trying to help in different ways. So if that's the case, then why would yield curve control ever be necessary, or negative rates ever be necessary for that matter, when it's not really attacking what the problem is?
That's a good point, Julie. You know, look, I think negative interest rates, at least right now, is a bridge too far. The Fed has been adamant that they want to avoid that at all costs. And I just can't see in any situation where that would happen, at least right now. Plus, if you look at historically, countries that have used negative interest rates, it really hasn't had a lasting effect or any effect to that in that nature. You know, Japan had negative interest rates for well over a decade. They're still sort of stuck in this non-growth situation. Europe, again, no green shoots whatsoever. You need to have a steeper yield curve. The problem is that a lot of what's happening right now is disinflationary or deflationary, and that's going to keep rates artificially low. So that's going to encourage people to take broader risk, whether that means in investment grade credit, whether that means in lower grade credit, or even equities, because people are used to getting, you know, mid single digit, high single digit, even double digit returns. And you're not going to get that when the 2 years trading at 15 to 20 basis points or the 10 years trading at 80 basis points. Yes, we've had a backup in yields, and now the bond vigilantes are kind of out in force saying that the curve is going to steepen and rates are going to move significantly higher. It's not going to happen. Front-end interest rates are going to stay pegged for the foreseeable future. The bar for the Fed or any central bank to be hiking their interest rates is really beyond reach.
Nick, this is slightly off topic from direct bonds, but when the Fed finally does launch the Main Street lending facility and they've lowered their requirements for that, do you expect that to have any impact on the kinds of bonds that we're talking about? I realize these are two separate issues, but it's all one huge Fed balance sheet.
It is. Look, our view right now is that investment grade corporates are really the new treasury. It's pretty simple when you think about it, that the Fed is essentially backstopped large corporations, particularly the ones that are issuing debt. They've started the secondary and primary corporate credit facilities. And while they haven't actually implemented that to its fullest extent yet, they have the power to really start address some significant buying power. So what does that mean? That means buying a treasury at 40, 50 basis points when you can buy a A-rated investment grade corporate at 100 basis points wider. To us, it's a no-brainer, because if the Fed is going to continue to backstop those bonds, at least provide that bridge until we get through this crisis, and you're essentially going to be rolling down the curve. Now, that doesn't mean that there aren't going to be winners and losers in this environment. I think it all comes down to a solvency question. But if you focus on high quality names, you don't chase returns, you should be able to get a decent return from your fixed income portfolio. And I think that the Fed will likely, like I said earlier, continue to upsize if this crisis continues. So that means introducing other forms of mortgages, other bonds but ultimately they have to find a way to help out Main Street, or they're going to be tagged with that same sort of brush that they did during the crisis in 08.
Hey, Nick, it's Julia LaRoche. Just kind of digging in more on the corporate bonds part. I don't know, it was probably like a year ago when you had some folks, some investors who were saying, the triple Bs were at risk of moving into the junk status territory, and that would cause a bunch of folks in mutual funds would have to, I guess, get out of those. Is that risk no longer on the table, or is it just minimized at this point?
It's significantly minimized, and that's a very good question, because that was a very large topic of conversations. Now, call me a bit of a conspiracy theorist, but the problem that I have with that whole concept is that while the rating agencies are supposed to be independent, look, they are looking through this crisis just as much as we are. And if they were to issue large-scale downgrades, even if they are warranted, that's going to set off a selling spree, because there are asset managers or pension funds that aren't allowed to hold high yield debt. So by moving an investment grade name to a high yield name, that's going to set off some selling and put us in a vicious cycle where there's forced selling, there's less liquidity in the market. Now, you go back to what the Fed has implemented, and I think this is largely why the Fed introduced or added on to their programs of including high yield names, is to really sort of counterbalance that if that were to happen. But the fact that the Fed is backing investment grade and to some degree double Bs is going to alleviate a lot of pressures in that space.
And Nick, we just want to remind everybody that we will be streaming Jerome Powell's press conference here on Yahoo Finance. Thank you for joining us, Nick Maroutsos, who is Janus Henderson's Global Bonds co-head. Good to see you. Stay healthy, sir.
Thank you, you too.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.